Hey traders, Jason here from Leavitt Brothers. The market got spanked last week. There's no way to sugarcoat it. The indexes have been trading in a range the last 2 months, but the bulls now don't have much wiggle room. In this video, I'm going to do an overview of what I see. It's an attempt to stand back and gauge the bigger picture instead of zeroing in on the short term. Okay. First, I'm going to cover the indexes. Then we'll look at some of the breadth indicators to see what they say. All right. So starting off, here's the S&P monthly. We got 2 big down months in a row. We do have 5 more days left this month. So, but barring a massive rally next week, this coming week, we're going to have consecutive down months for the first time since 2015. Okay. Overall, the market's still doing fairly well. Okay. It's not going to just go up and up and up. If you look at the rally from the 2016 low up until the early 2018 high, I mean that's unsustainable. It's like up month after up month after up month. The market just kind of grinded higher and higher and higher, and there were like no disruptions. So the fact that we've actually had 2 down months in a row, from a long-term standpoint, it's not that bad. The index is below its 10-month moving average. So it's worth noting, like maybe we just, this is a disruption and it's probably going to take some time to heal, but it's not the end of the world, and we do know that tops take time to form. So maybe we have some follow through, maybe we have a bounce back up to the high, maybe we have a move down after that. Overall, the market is doing fine, but obviously if you operate, in the shorter term or even the intermediate term, you have to make changes to how you operate. Here are the weekly charts. S&P 500 up top, Russell 2000 down below. I've been very clear for a really long time that the 50-week moving average is very important to me. You can see support here with the S&P a couple times, support back here in February. With the Russell, it's the same thing. You have resistance here and here. You have support here, 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 and here. In both cases, we have support levels that come into play at approximately the same level as the 50-week moving averages. So needless to say, the bulls kind of sort of have their backs up against the wall. If they don't right now, then they will pretty soon. You don't want to see these moving averages being taken out. Okay, I'll allow for a little bit of wiggle room. The market isn't that exact. Support, resistance, those are areas, not exact levels. So if we get minor breaches of these levels, it's fine. But you don't want sustained prints below them. You don't want them to close below them. Otherwise, bad things are going to happen. Again, tops take time to form. So if we start getting closes below them, then that moving average becomes resistance. And rally attempts are going to have a hard time getting back above. Okay, so right now, overall, market's not in bad shape. Okay, the trend lines are still moving up. Not the trend lines, but the moving averages are still moving up. You can still say we're consolidating above the key moving average, but again, the bulls are going to have their backs up against the wall soon. Here's the daily S&P. Okay, big move down, choppy move up, big move down. Now we're sitting on a closing basis. We're sitting near the February low. We're also sitting right above the 200-day moving average. Okay, again, allowing for a little bit of wiggle room, a little bit of a move below the 200 is fine, but it can't stay down there. If it stays down there, then that moving average becomes big resistance. Okay, aside from all the trading that goes on between me and you, we're just like we're small fries in the market. The big institutions do pay close attention to the 50, the 200, and if we get sustained prints below the 200, those entities are going to start unloading some stocks. Okay, and they're not that they're the smart money in the market, but they're the big money and they can move things. So the 200 is very important here. Okay, here's the Russell and the S&P 400 mid cap daily charts. In both cases, the 50s have been important. Just say looking at the mid caps here, first attempt to get above the 50 failed. The second attempt succeeded, but then on the way back down, it only took a couple days of hesitation. Then we sliced through it. That's now going to be resistance on the way up. And if you look at the charts, I mean, these are basically neutral indexes that haven't really done anything for the last couple months. If I just kind of draw a line here, like with the Russell here, like this 1460 level seems to be pretty important. So if I drew a box with 1460 being the bottom, you can see resistance here, got above, tested it again. So we're basically a neutral market going back, 5-6 months. Nothing wrong with that. The market was up for so long that it's permitted to rest. But before we get excited about anything going, happening to the upside, this range is going to have to end. So overall, I guess you can say the market isn't in bad shape. Okay, we moved up for almost 2 years, and now we're basically moving sideways, which isn't a bad thing. But if you're a short-term trader, you got to adjust your trading style. You can't just blindly buy every dip, thinking you're gonna make 20 or 30%. Now trades might only last a couple of days. You never know. Okay, so these charts are neutral at best, and if they fail to get above their 50s, then they're gonna say that they're turning down. All right. Last chart among the indexes, I've been very clear that the market does best when the NYSE and the NASDAQ move together. Okay, whenever they diverge, and it doesn't matter which one moves up and which one moves down, whenever they diverge, the market runs into trouble. We got a big divergence just 2 weeks ago where the NASDAQ right here made a new all-time high. The NYSE put in a second lower high and got capped by its 50-day moving average. Right now they're on the same page, which is nice, but they're on the same page going south. So as long as this remains the case, as long as whenever these two diverge, the market just doesn't do very well. So it was a warning sign 2 weeks ago that we put out to subscribers. We've been talking about it for a while, and so anyone who's been following us knows that this being an important indicator for us kind of was forewarned that trouble was probably brewing. All right, let's go through some of the breadth indicators. Okay, here's the S&P 500 up top versus the 10-day moving average of the NYSE advanced decline line. Okay, you can see the divergence that formed. S&P put in a higher high. AD line put in a lower high. Okay, so on this move up, advancers were beating decliners. On this second move up, advancers were beating decliners by a smaller amount. Less stocks were advancing, more stocks declining. Less stocks were participating. That's a warning that typically does not end well. Typically, it takes a little while for this. This indicator is not extremely sensitive, or I should say, the market is not extremely sensitive to this indicator. So it typically takes longer, but because the market is just volatile and moving up and down very quickly, in this case, it played out pretty quickly. So this is something that we've been pointing out at Leavitt Brothers. So anyone who is subscribed has known that this was in the pipeline, and probably lower prices were probably in the pipeline because this was forming. Okay, here's the cumulative version of the AD line chart. As you can see, we're basically flat. We're flat, and the moving average is losing its importance. The indicator failed to confirm any type of uptrend. If you can look over here to 2016, where the indicator moved below the moving average, tried to move above and got rejected, moved down again, but then once it moved up and then came down and tested it, and then it trended up, and that was the beginning of the next uptrend. That hasn't happened here. Okay, we moved below. It took a couple times to get above, and it had a chance to hold the 50 and then trend up and to confirm or at least support a resumption of the uptrend. It didn't happen. It just sliced right back through. So now I can say at best, this thing is just moving sideways. It's moving sideways in a range just like that. The 50-day moving average is flattened out. It's not extremely bullish. It's not extremely bearish. It's just a resting period within a long uptrend. It tells us to shorten our time frames on our trades. Okay, if you buy and hold for several weeks, maybe a month, maybe 2 months, nail 20-30% moves, you might have to shorten. You're going to have to shorten up. You may buy and only hold for a couple days now. Okay, that's just the way it is. You got to make adjustments based on what's going on in the market. And the fact that this is flat, the moving average is flat, tells us everything needs to be shortened up because we're just not going to get follow through. Okay, here's the S&P 500 versus the NYSE AD volume line. We got the same divergence. So obviously the AD line counts every stock equally. The AD volume line lets the bigger cap stocks that have more volume count And the message is the same. We got less participation on this most recent move up, and that kind of hinted that this higher high right here probably wasn't going to continue. Okay, well, we weren't going to get any follow through. We weren't going to test the highs at this time around because less stocks were participating. Here's the cumulative version of that chart. Similar situation. It's a little bit better than the 80 volume, but the 80 line, but it's very close. We've been in a range for several months. The 50-day moving average is flattening out. This tells us, things aren't bad, but they're not as robust and strong as they once were. So we have to adjust what we do. New highs have been an issue. If you're familiar with my work, you know that I look at the amount of time that new highs spend at a low level, and I relate that to how long the market is likely to consolidate. If you look over here to like August of last year, it spent about a month down here, and we got this consolidation period. But over here in November, all we did is get a dip and then a quick recovery, so the market didn't pause that long before resuming. So for the last 2 months, I've been saying, hey, the length of time this spends down here is going to determine how long the market consolidates and eventually moves up. And as you can see, we've been down here for 2 months, which is the longest it's been down here for a while. As long as this remains the case, the market will not rally much. It's pretty simple. Okay, the market's just not going to move up unless new highs are expanding. Okay, it's mathematically not possible. You need the leaders to lead. You need the leaders to be pulling the market up. The market is always top heavy. Okay, you never have a situation where all stocks do very well. You always have a situation where like maybe 10 or 15% of the stocks are pulling the market up, or everything else is just kind of neutral, trading in line with the S&P, a little bit better, a little bit worse. So you need a basket of stocks which are doing really well, and it's just not happening. Okay, for 2 entire months, new highs have been depressed, and as long as that remains the case, every rally is going to be capped. There's not going to be any follow through. Here is the same chart, but it's the weekly version. You can see there's pretty good correlation between bottoms in the weekly new highs and bottoms in the market. Okay, just as an example, you can see right here in 2016, bottom here correlated here. Bottoms with the weekly new highs can also correlate with like little inflection points, as you can see like right here, where a market that was trending up actually accelerated up. So again, the market is going to be capped as long as this indicator is moving down. Okay, we went from a 15-month high or something like that all the way down to a new low here, or a lower low. Until this indicator moves up, no rally attempt will have legs. Okay, we can bounce. There are going to be some big bounces along the way. We could bounce for a whole week, but until this indicator actually starts to expand, no bounce is going to last long. Here's the NYSE. Here's the S&P 500 versus new lows at the NYSE. You can see we haven't gotten a spike yet, which to me is bearish. Okay, if on the move down here in January, early February, we got this huge spike. Okay, which helped put in a bottom. Right now, we don't even have a spike, which tells me we haven't had a complete washout. We haven't had capitulation. We haven't had people throwing the towel. So more likely than not, last week's selling probably has more to go before we can actually put in a tradable bottom. Here's the S&P 500 versus the high-low differential at the NYSE. I've been very clear over the years that a characteristic of a healthy and strong market is steady, consistent prints above zero. Obviously, we don't have that. Even if I were to cover up the S&P chart here and you were just to look at this and make decisions, you could just simply say, hey, as long as this is above zero, I'm going to be long, and if it goes below zero, I am going to get out. If all you did is look at that, the new highs versus new lows, you'd do very well in the market. Amazing how complex some of the analysis techniques are, yet if you just did that, you'd probably nail most of the uptrends and be out during most of the downtrends. Obviously, we're below zero now. Repeated trips below, I don't interpret those as pounding out a bottom. I view those as pecking away at strength. Okay, we have repeated trips below zero, just kind of eats away at the market's internal strength, and eventually that's going to give way. So this is not a good thing. Here's a cumulative version of that. we've run into issues before, but we've always been able to brush them off because the cumulative high-low has stayed above its 50-day moving average. Now it's below its 50. This is the first time since the beginning of 2016 that the indicator is below. To give you an example, the last time you can see mid 2015 where the indicator trended down below its 50. The market, as you can see here, moved sideways. So when the market moves sideways, it gives the appearance that it's neutral, but below the surface, this was deteriorating, and eventually it just fell apart. And we ended up having an entire year, even more than a year, of sideways movement. Okay, so right now, we can look for that right now. If the market continues to move sideways and this ends up deteriorating even further, we're going to have the upside's going to be limited. Okay, I'm not going to predict that the market's going to completely fall apart. But as long as this is below its moving average, the market just simply is not going to rally much. There will be pops, there will be rallies. The biggest up days in the market do take place on within downtrends, so there will be individual days where the market rallies huge. But overall, nothing will sustain itself as long as this is below its 50. Okay, a couple more charts. This is the S&P 500 versus down below versus the percentage of S&P stocks above the 20-day moving average. A characteristic of a strong and healthy and uptrending market is consistent prints above 50%. You can see each of these blue boxes are representative of that. Moves below 50%, as you can see, these red boxes here correspond very well to resting periods. Obviously, we've had huge volatility over the last 2 months. Okay, we've had prints above 50%, but nothing has sustained itself, and now we have a really low print below 10%. As long as this indicator fails to move above 50% and stay there, the market will not sustain any uptrend. It's as simple as that. Okay, sure, low prints could correspond to temporary local bottoms, but again, until we can sustain prints above 50%, the market's upside will be very limited. Backing up, here's the percentage of S&P stocks above their 50-day moving averages. The key level here is 55%. Okay, characteristic of a strong and healthy market is consistent prints above 55, as you can see in the blue boxes. Dips below tend to lead to consolidation periods. Now we don't just have dips below, we have sustained period below and a complete failure to move above 55%. As long as this remains the case, the market will not move up. Okay, it's as simple as that. The market simply, you can't have, if the 50-day moving average is very, very important, you can't have 35% of stocks above their 50-day moving average and have the market move up. It's just not mathematically possible. Okay, it can happen on a day-to-day basis. It can even happen for an entire week, but on an overall basis, it's a rally is not going to sustain itself unless more stocks are above their 50. Okay, last chart. This is the S&P down below. Up top is the S&P 500. Percentage of S&P 500 stocks above their 200-day moving averages. Okay, obviously a very important level for big institutions. I don't think there's a magic level here, but we did put in a negative divergence here where the S&P moved to a higher high. Percentage of stocks above their 200 put in a lower high, and obviously has now plunged to its low, to a low that it hasn't hit in more than a year. Okay, again, as long as this persists, the market's not going to move up. You simply can't have so many stocks below their 200 and have the market move up. It's just not mathematically possible. It can take place over short periods of time. It cannot persist for longer than that. Okay, so overall, the market isn't in horrible shape overall. Okay, but certainly in the near term. And I don't really care that much about the near term. The intermediate term, looking out a couple weeks, a couple months, the market is not in great shape. A lot of the breadth indicators have broken down, so we got to be really careful. In the past, miniature rallies would be a reason to increase exposure. Let's get long. Let's really push it. Now, when you get a mini rally, that's probably a reason to take money off the table and either go short or go to cash and wait for a dip, for the next buying opportunity. Okay? Come check us out at Leavitt Brothers. For a small annual fee, we'll save you a ton of research time. Our weekly report discusses the long and short-term trends and the staying power of those trends. It's only $149 for the year. Our sector breakdown and trading ideas report offers many new trading and investing ideas. It's only $2.99 for the year. One good trade pays for your subscription for the entire year. Come check us out.